Hello Business 201. This accounting video demonstrates how adjusting journal entries affect the financial statements, and particularly how adjusting entries affect the net income. Because business owners are keenly acute to how changes in income affect their well-being, any accountant that makes an adjusting journal entry that affects income will keep their attention. So the emphasis on this particular video will be the effect on net income. The setup is that we will review the in-chapter example of NetSolutions for Chapter 3. The adjusting entries that you see on the left-hand side of the Excel spreadsheet are the same adjusting journal entries that you see on page 120 in Exhibit 9 of your textbooks. Our job is to show how each of these journal entries affect the financial statements on the right-hand side, and then to show the cumulative effect of all of these journal entries together on net income. The convention that we will use on the right-hand side is to show increases as positive values and decreases in accounts as negative values. Let's get started. The first journal entry, decreased supplies expense and decreased supplies, the asset, and increased supplies expense. So the debit to expense would increase the category expenses, and the credit to supplies would decrease an asset. So we will enter in a negative 1240 under assets. At the end of each transaction, the balance sheet should balance. In this case, it does not, so what we should do is to account for the secondary effects. If expenses increase, well, that will cause a decrease in net income. If net income decreases, it will also decrease earned capital. So now the balance sheet balances, and that indicates that this journal entry decreased assets, increased expenses, and decreased income and equity. Because there was no debit or credit to cash, there was no cash flow effect. Let's examine entry B. In this case, it's very similar, where the expense, insurance, increased $200. Prepaid insurance, an asset, received a credit, so a credit to an asset account, which resides on the left-hand or debit side of the balance sheet, would cause the asset to decrease. So we will enter a negative 200 under assets. The balance sheet doesn't balance from the primary effects, so we must examine the secondary effects. If we increase an expense, that will in turn decrease net income, and a decrease in net income will cause a decrease in earned capital. Checking to assure that the balance sheet balances, it does, we can say that the second entry decreased assets, increased expenses, and decreased income and equity like the first transaction. The third transaction represents a decrease in unearned rent and an increase in rent revenue. Unearned rent is a liability for a service payable. Payables appear on the right-hand side of the balance sheet. Making a debit entry to a credit balance account will decrease the liability account, in this case by $120. A credit to revenue will cause revenue to increase because revenue is part of owner's equity, the earned capital, and increasing revenue increases owner's equity. So revenues increase with credits. The balance sheet doesn't balance, so we must account for the secondary effects. If revenue increases, we have increased income, and if income increases, we have increased equity. So the effect of transaction C is to decrease liabilities and increase revenue, income, and equity. In transaction D, the asset accounts receivable is debited. A left-hand debit entry to an asset account increases the asset. Fees earned is credited. Revenue resides on the equity side of the balance sheet, the right-hand side. Making a credit entry to a revenue account will increase the revenue. Because the balance sheet does not balance, we must account for the secondary effects. If revenue increases, that in turn increases income, and if income increases, that in turn increases earned capital or earned equity. The balance sheet balances, so we've completed transaction D. Transaction E, wages expense are debited, wages payable are credited. A debit to an expense account will increase the expense. Expenses serve to decrease owner's capital, and a debit to a right-hand credit balance account like capital will decrease owner's equity. If an expense increases, that will decrease net income, and the decrease in net income will decrease earned capital. Wages payable is a liability and is increased with credit side entries. Because the credit for $250 was to wages payable, that increases the liability in the amount of $250. The balance sheet balances, so we have completed transaction E. Now, for the final transaction F, the company recorded depreciation expense. Depreciation is an expense and is increased with left-hand or debit side entries. Accumulated depreciation tracks the credits that represent the cost of a piece of equipment that has been consumed in the production of revenue. So a credit to accumulated depreciation represents the amount of the asset that has been used up, and when an asset has been used up, its balance decreases. The balance sheet doesn't balance, so let's account for the secondary effects. If expenses increase, that means net income will decrease, and the decrease in net income in turn decreases owner's equity. Examining the accounting equation, assets equal liabilities plus owner's equity, these two are in balance, and we have accounted for all the effects of the journal entries on net income. Now, what is the cumulative effect? The original trial balance, that is in Chapter 3 for NetSolutions, showed that the net income was $2,555. This appears to you on page 110. Now, the $8,255 will in turn be reduced by $1,120 so the adjusted net income for this example would be the original net income less the net income decrease that came about because of the adjusting entries, or $7,125. So for this particular problem, the adjusting entries reduce the owner's income by about 12%. And so we should be very careful in explaining exactly what happened with these journal entries to the business owner. In the next video, we will examine these same entries, but look at them from the perspective of what would be the effect on income if we forgot to make each of these entries. Give exercise or problem 3.3a a try and apply this type of logic to the journal entries. Thank you.